Hey Realtors, my name is Steve Doherty. Today I want to walk you through mortgage insurance on conventional mortgages, otherwise known as PMI. Mortgage insurance is required on Fannie Mae and Freddie Mac mortgages when your buyer is putting down less than 20%. By the end of this video, I want you to be able to speak clearly and competently on how mortgage insurance works, to be able to thwart the excuse from a potential buyer that they don't have 20% down so they can't buy yet, and also be able to explain how mortgage insurance cancellation works. Let's take a look. Before we dive into that, my name is Steve Doherty. I'm a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. I am licensed to do mortgages in South Carolina, North Carolina, and Virginia. I will leave my contact information in the video description and in a pinned comment if you would like me to walk your buyers through mortgage insurance. What exactly is mortgage insurance and why is it there? Well, it is an insurance policy, and it is adding protection for the mortgage lender when they are giving a loan at an enhanced risk profile. And that enhanced risk profile is a buyer who is putting down less than 20%. How you should be communicating that to your potential buyers is that this is a program that allows you to buy a home without having to save up 20%. Mortgage insurance is allowing you to get into a home earlier. So the way mortgage insurance works mechanically is that there is a mortgage insurance rate that is applied to the starting loan balance. It does not adjust monthly like the interest rate applied to a amortized mortgage loan. It is a rate applied to the starting loan balance. So obviously the bigger the down payment, the less the mortgage insurance, but keep in mind that there are sort of breaks that are achieved at certain down payment thresholds. When you put down 5% instead of the minimum 3% on some programs, when you get to 5%, you get a big break. At 10%, you get a big break. And at 15%, you get a big break. What exactly does that mean? It means that your coverage will drop if you put down 5% instead of 4.99. So what determines the mortgage insurance rate and corresponding payment? Well, obviously the loan amount. That's really the big one. Within that, the down payment. What percentage down payment are you making? 5%, 10%, 15%? Remember, at those thresholds, you get a little bit of a break. Credit is also an important factor in the mortgage insurance payment. Generally speaking, borrowers will max out mortgage insurance, meaning they'll get the best payment with a 760 credit score. The debt to income ratio also plays a factor in determining what that ultimate payment will be. At certain thresholds, you get a break. The lower the debt to income ratio, essentially the lower the risk you are, the lower your mortgage insurance payment will be.